Good morning. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu, the Head of Brand Marketing and Communications at Genghis Capital. Today is the first Monday of September, so we have high expectations. I read somewhere that the last 4 months of the year is when people make very unwise financial decisions. I think this is because there are a lot of festivities and holidays coming up. But the aim of this webinar is to help you make better financial decisions when it comes to the fixed income markets and the equities markets. So with us today is the head of research, Churchill Ogutu. He's joined by his two research.
Seems like we've lost Damaris, but nonetheless, the show continues. So she was ideally introducing my team members. We'll be running you through our presentation, talking about the macro, what happened last week, getting into the fixed income, and then equities bits. So without further ado, I'll ask Melody to share the screen so that we can start it off.
I just realized, unfortunately, my rights are not enabled for sharing the screen.
Oh, today is that day. Dan,
looks like.
Grant us the sharing rights.
Done.
Okay, Dan has done, so we are good to go. No pun intended. Okay. Awesome. So as usual, I'll start with the macro and fixed income. Then my colleagues will finish off with the equity segment. So review for last week, the indicators that came out last week, we had inflation came out the last day of August. Looking at the review of inflation for that particular month, headline inflation edged up to 6.57%. But then for the July data, there was some revision. The data that was announced the previous month had inflation at 6.44%. It was revised to 6.55%. So it was more or less a moderate uptick from 6.55%, the revised headline inflation data, to 6.57%. So not much of a movement. Core inflation went down from 2.9% in the month of July to 2.6% in the review month of August. Food inflation, also there was a revision in the data for the month of July. Initially, it was at 8.8% that was recorded for the month of July. It was revised upwards to 9.1%. And then for the month of August, that particular print went up to 10.7%. And fuel inflation, also another revision in the month of July data, from 11.8% to 12%. And then for the month of August, we saw it coming down drastically to 9.2%, obviously, based on the global oil prices in that particular review month, which was reflected by the April fuel pump price review in that particular month, which we saw moderation in the terms of pricing. No change was affected. So that's basically our the August inflation data. More or less, we are seeing a slight uptick as compared to what happened in last year. So, but still within the target range of between 2.5% to 7.5%. The other piece of data that came out was the Purchasing Managers Index. Basically, this is an indicator which is a pulse of the private sector sentiment. Any number, a number above 50 shows expansion in sentiment, a number below 50 shows a contraction in sentiment. So for the specific month of July, August rather, it was at 51.5 as compared to 50.6 in the month of July. So that was just more or less, sentiment has still been positive. This is like the fourth consecutive month of positive sentiment amongst the private sector players. This week, the calendar in terms of macroeconomic indicator data is quite light, but nonetheless, we should expect the release of the money supply data by the central bank. That we can also get the private sector credit growth. In terms of the bills in parliament, well, it's anyone's guess what will pan out this week. But I think the other critical data point to keep an eye on is now the budget review outlook paper. The draft was finalized last week, so it's a matter of the cabinet approving it before it's tabled in parliament. So that's something that might play out in the course of this week. So jumping on to the fixed income, a review of last week's market activity, secondary markets declined by 15% week on week to close to 11 billion. Most of the activity was in the primary bond papers whose initial tenor was 10 years and also 15 years. So that's pretty much the middle part of this yield curve. That's where the activity was over the course of last week. But nonetheless, we've seen last week was the 5th consecutive week whereby we've seen a week-on-week decline in terms of activity in the secondary market. So that obviously the primary bond auction that still played out, primary bond sale rather, that played out in the course of last week, sniffing out life in the secondary market. So that's not, that was expected. T-bills, we saw a rebound to close to 24 billion that was on offer with a performance rate of 99.5%. In terms of the tenors, yields on average went up 3 basis points or 0.03% on a week-on-week comparison. So that's what played out in the discounted security segment. In terms of the liquidity over the course of last week, interbank rate declining on average 0.17% as compared to the previous interbank rates average. So last week it averaged 3.34%. That was a decline. And also CBK was quite aggressive in the mop-up, liquidity mop-ups over the course of last week through what is called the term auction deposits. So the bids that were received over the course of last week was around 119 billion. It accepted 107 billion at a weighted average rate of 5.46%. So think about it. All the days last week, the assessment of CBK was that the market was liquid in excess of what it's warranted. So it mops up the excess liquidity. And then the average rate that was accepted was around 5.46%. So these are 7-day tenors. And that to us is telling us that even this auction that is coming this week, the IFB auction, which we'll speak about at length in the next slide, perhaps we'll see elevated subscription just based on this liquidity that is there, that is playing out. In terms of calculation for the net domestic borrowing of the government securities, that's basically T-bills, T-bonds, netting it off, maturities. Our calculation, it is around 165 billion, and that represents around 25% of the target for the current financial year. So at this point in time, we are way ahead of the borrowing curve. So at some point later on in the financial year, the fiscal agent or treasury will sit pretty much pretty if this trend continues, being ahead of its borrowing curve as the fiscal year rolls out. So that takes us to our week's trade. That's on the auction for the IFB infrastructure bond, the 21-year, whose weighted life is 15.5 years. 15.5 years in the sense that it's a 21-year paper, but on the 10th year, you receive half of your investment. So for instance, if you invest 100,000, in year 2031, you receive back your 50,000, and then the 50,000 continues up until the end of the remaining 11 years. So if you average that, it's coming to 15.5 years. So the target is 7.75 billion from this infrastructure bond. Is supposed to go to funding infrastructural projects in the current financial year. We did some quick calculation of what is not funded. Ideally, when the budget formulation comes in, there's the recurrent expenditure, there's the development expenditure. And we know from the Finance Act 2021 that there are some definition of what is an infrastructure bond. Is the funding of infrastructure, either a road, either a water or sewerage system, either a port, either a hospital or a sporting facility, or communication equipment network. And those are 6 different ministries and departments. So looking at the aggregate development expenditure in the current financial year of those 6 MDAs, ministries and departments, it was coming to around 420 billion. And then what has been catered for in the sense that some of these MDAs has been funded by external financing, others be it loans or grants, and others from what is called the appropriation in aid, basically the internally generated funds. So the non-funded component of those 6 ministries and departments, it was coming to around 140 billion. So therein lies the justification of this infrastructure bond, in as much as the specifics of where the sectors, beneficiary sectors will be was not specified, but ideally we're looking at a funding deficit of around 140 billion. So that's where the justification of the IFB is coming from. So in as much as they're looking at 75 billion, we suspect that there's a green shoe option. Green shoe option is, well, they can accept over and above that amount. So we estimate that it will be another green shoe option of 25 billion. So in the case that the bids are over and above 100 billion, what we see that they can be able to accept, the maximum amount they can accept from this auction is 100 billion. We talked about the liquidity in the current system, and based on that, we could see some undercutting in terms of investors who really want to get a share of this infrastructure bond. They're bidding lower levels so that they can be able to increase their odds of being accepted for this IFB. So all that, and looking at the last IFB that was issued in April, this paper was issued at 12.67%. It has declined close to 60 basis points is 0.6%. To last week, it was trading at 12.06, 12.05%. So that is the paper that we were benchmarking it on. And then we add an additional 0.5% on that April IFB paper. So we are looking at an average of between 12.5% to 12.7%. So that's our recommendation for the auction for as you place your bids for this particular paper. Nonetheless, you can still play safe if you have capital or an investment below 20 million, just put in a non-competitive bid that you're assured that you'll be able to get a hold of this paper. Let me stop there. My curtain raising duties has come to an end. So let me call my equities colleagues to pick it up from this point. Over to you, Melody and Wesley.
Good morning to you. The market retreated during the week as signaled by the benchmark indices. The Nairobi All Share Index and the NSE 20 Share Index dwindled 4.1% and 0.4% week on week respectively. That said, activity in the week ended in the negative territory, posting a 15.6% week on week dip in turnover to about 2 billion. The top gainers in the week were Nairobi Business Ventures, Scan Group, Crown Paints, EA Cables, and Capture-T. NBV peaked 30% week on week, closing the week at 6.88 shillings. NBV's strong performance was on the back of its financials, which are quite strong. The business is expected to pay for the acquisitions in cement manufacturing, aviation, and automobile servicing through a share allocation to the shareholders of Air Direct, Delta Automobile, Delta Cement, and the Aviation Management Solutions Limited. And the key agenda for the 22nd September AGM will be on the authorization of the board to implement the proposed transaction and to increase authorization of share capital from 500 million to about 1 billion. As we wait to see how the second phase pans out, we expect to see some rally based on the news that come out. Scan Group, on the other hand, registered an impressive performance, rallying 29.69% to close the week at 4 shillings and 63 cents. This performance was converse to the released numbers, taking into account a sharp decline in its reported bottom line. The uptick thus zeroes into the exoneration of the earlier suspended senior management, which boosted investor confidence in a good way. Moving on to the week laggards, we had HF Group, Equity, Kakuzi, Sanlam, and BK. Looking at foreign participation, foreign investors exerted their dominance in the bourse, accounting for about 56.7% of the week's turnover. They exited across key stocks to clock net outflows of 208.4 million, mostly bearish on Safaricom, KCB, EABL, and Bamburi, while accumulating on Equity Group. 14 counters released their financials in the week, and though in the negative territory, Standard Group reported a 77% year-on-year improvement in its earnings per share, from a loss of 3 shillings and 1 cent to a loss of 67 cents in the period under review. The counter registered a 14.4% year-on-year growth in its top line, with revenues coming in at 1.6 billion. The total operating cost declined 7.9% year-on-year to about 1.6 billion, and the finance cost closed the period at 81.6 million, registering an 11% year-on-year growth. Loss after tax for the period reported an 80% year-on-year improvement, coming in at 61.2 million after an income tax credit of 26 million on losses for the period that came in at 87.2 million. The balance sheet grew 4.5% year-on-year to 4.2 billion, and it closed the period in a negative cash position. As a side note, a negative cash flow position implies that the business has more outgoing cash than incoming cash. This, however, is not necessarily a sign of financial strain unless it becomes chronic and persistent. If the other ratios, such as the quick ratios and the current ratios and the debt to equity ratios, are well poised, then the story conveyed by a seasonal negative cash position is that of expansion or a likely business cycle. Moving on to Crown Paints, they reported a 34.4% year-on-year rise in earnings per share, from 3 shillings and 55 cents to 4 shillings and 77 cents. The counter reported sustained growth in the top line, with revenues coming in at 4.9 billion. Profit for the year registered a 34.4% year-on-year growth, coming in at 340 million. And the comprehensive income for the period came in at 457 million on a 118 million adjustments from revaluation gains on property, plant, and equipment. The pandemic has had an adverse effect on the cost of production and the cost of raw materials and transport costs, which exerted pressure on profitability and the cash flow. The counter's balance sheet grew 16.9% year-on-year to 6.6 billion, and it closed the period at a cash position of 86 million, which is about a 77% shrink from the similar period last year. The board did not recommend an interim dividend, and the management maintains a bullish outlook for the second half period of the year. Homeboys reported an improvement in its earnings per share from a loss of 10 cents to a loss of 4 cents. Turnover declined 4.4% year-on-year to 63.3 million, and the direct cost declined 9.7% year-on-year to 26.8 million. This translated to a gross profit of 36.5 million, and expenses declined 18.7% year-on-year to 33 million. The net profit for the period was reported at 3.5 million, which was about a 186.9% year-on-year decline. Notably, finance costs grew 50.6% year-on-year to 1.2 million. and the profit for the period came in at 2.3 million, registering a 161.7% year-on-year growth. The balance sheet grew 11.8% year-on-year to 119.6 million, and it closed the period at a negative cash position. The board did not recommend an interim dividend. Looking at Home Africa, they reported a 8.4% year-on-year improvement in loss after tax from 243.2 million to 222.8 million for the period ended 30th June 2021. The company's asset book fell 8.2% year-on-year to 4.1 billion, in part due to a decline in trade and other receivables, which fell 57.2% year-on-year. Revenues from contracts with clients fell 34.5% year-on-year to 28.2 million, with cost of sales rising 10.5% year-on-year to 31.9 million. Consequently, gross profits dropped to a loss of 3.7 million from a profit of 14.2 million in 1H20. Administrative expenses grew 24.1% year-on-year to about 122.7 million, and the loss before tax and the total comprehensive loss for the year were reported at 222.8 million, and the board did not recommend an interim dividend. Nairobi Business Ventures reported its revenues for the year at 45.4 million vis-a-vis a nil turnover in the previous year, as the counter restarted its business during the period under review following Delta's acquisition. The cost of sales came in at 41.8 million, and the company registered the period's gross profit at 3.6 million. Notably, administrative expenses declined 42% year-on-year to 12.3 million, when other income grew 331.8% to 41.7 million. Profit for the period was reported at 32.9 million, registering a 183.5% year-on-year growth. The counter's equity base grew to 148.9 million on account of 537% year-on-year growth in share capital to about 246 million. The overall balance sheet came in at 177.8 million, and the board did not recommend a dividend payment. Looking at Kenya Orchards, they reported a decline in the earnings per share from a loss of 5 cents to a loss of 29 cents. Revenues declined 12.4% year-on-year to 24.8 million, and the cost of sales came in at 27.7 million, registering a 2.7% year-on-year growth. Gross loss for the period was reported at 2.9 million, and notably expenses grew 8.7% year-on-year to 2.1 million, while finance costs declined 13.9% year-on-year to 0.2 million. The company realized a comprehensive loss of 3.7 million for the 6 months period ended 30th June 2021. Its balance sheet shrunk 13.3% year-on-year to 109.4 million, and it closed the period at a negative cash position. rwitu Ventures reported a 72.9% improvement in the loss for the year from 2 million to 2 million for the period under review. The group's operating expenses declined by 74.3% year-on-year to 2.7 million. Income from equity accounted investments fell to a loss of 0.06 million from previously positive of 0.3 million. Loss for the year before tax improved by 72.9% to 2.8 million, and the taxation charge fell by 72.8% year-on-year to 0.8 million. The balance sheet declined marginally by 20 basis points to 552.5 million, and the group closed the year at a reduced cash position of 0.8 million, which is about 70.9% year-on-year decline. WPP Scan Group reported a sharp decline in its earnings per share from a profit of 0.34 in FY19 to a loss of 3 shillings and 89 cents in the period under review. Revenues declined 22.1% year-on-year to 2.2 billion. Interest income for the period came in at 204 million, registering a 10.2% year-on-year growth, and interest expenses in line grew 12.2% year-on-year to 22.7 million. Notably, operating and administrative expenses grew 26.3% year-on-year, closing the period at 3.5 billion, and impairment on investments in associates and impairments in goodwill were reported at 158.8 million and 315.7 million respectively. The company registered a loss of 126.7 million from discounted operations and net gains of 2.2 billion. Loss after tax came in at 1.7 billion after a tax adjustment of 278 million on the period's loss of 1.5 billion. The group's balance sheet shrunk 31.7% year-on-year to 8.7 billion, mainly due to disposal of the Counter Africa businesses, and the Counter closed the period at a cash position of 1.9 billion, which is about a 12.7% year-on-year decline, and the board did not recommend a final dividend. Looking at the sub-Saharan market performance, the Nairobi All Share Index outperformed its peer on a week-on-week median. The market's price to earnings ratio was above the African median multiple of 11.6, while its dividend yield was below the median by about 2%. Looking at the corporate calendar, in addition to Stanbic BOC and Jubilee's interim dividend, we have a date on Centum's book closure for the 33 cents first and final dividend, which is on 8th October 2021. To you, Melody.
Thank you, Wesley. So we're just going to have a highlight on the financial sector. So the banking sector counters have been seeing a bearish sentiment this week, with all of the counters experiencing a drop in prices. So the four highest losers were ABSA, BK Group, Equity, Housing Finance, HF Group, and KCB. So ABSA closed the week at 10.55, which is a 4% decline week on week. BK Group at 36 shillings, which was a 10% drop week on week. Equity at 49.9, which is a 7.59% drop week on week. Housing Finance at 3.66, it's a 5.18%. And KCB at 46.8 shillings, that's a 3% decline. So looking at the insurance sector, the counters were relatively stable, with, however, Liberty and Jubilee closed the week lower. Liberty at 8.3 shillings, that's a 6% drop, and Jubilee at 360 shillings, that's a 4% drop week on week. So NCBA, Stanbic, and Cooperative Bank have acquired a 31 billion shilling pension deal. So these three banks won a contract to keep more than 31.2 billion in annual contributions by public servants following the rollout of the fund on January 1st this year. So the Treasury had picked these three banks, and it's going to collect pensions for over 350,000 civil servants, including police officers and teachers. So civil servants, unlike workers in the private sector, have not been contributing to their pension, and the benefits were coming straight from taxes. So previous attempts as far back as 2008 to transition to their own contributions took a bit of time until last year when Treasury gazetted that change. So the change paved the way for Treasury to set up governance structure for the scheme, including appointment of trustees as well as fund managers. So now public servants will now be contributing 7.5% of their pay from the start of January this year. So secondly, the IRA, that's the Insurance Regulatory Authority, plans to overhaul the underwriting laws as insurance penetration falls. So they've been collecting proposals from the public as well as policyholders and insurers so that it can make the Insurance Act more responsive to the needs of stakeholders. So mainly they're going to focus on improving access to insurance services through the use of technology, and also enhancing mechanisms for protection of insurance customers. So there's a report that IRA had released that indicated that insurance penetration in Kenya has dropped to about 2.34% in 2019, which is actually the lowest in 15 years, mainly due to price undercutting and competition. So they want to review the premium rates in the market so that it can find a way of curing this price undercutting issue, as well as now these new rates will be determined for selected classes of insurance so that they can strike a balance between affordability and the stability of the insurance companies. Thirdly, the banking sector contributed 27% of corporate tax in Kenya in the period 2019 to 2020. This was as a finding by a report by the PwC on behalf of Kenya Bankers Association. So this was mainly due to a reduction in corporate tax rates. Remember last year that government gave some concessions where the corporate tax rate went down from 30% to 25%. The pay went down from 30 to 25, and a cut in VAT as well from 16 to 14%. So all these factors contributed to the reduction in tax collected. So also another thing is that it meant that for every 48 shillings and 50 cents out of 100, that was going to tax. So mostly KBA attributed to the higher taxes that they pay. You might find that the tax rate is higher than the actual 30%. Mostly it's because of the misalignment between provisioning for accounting purposes and the actual deduction of the same provisions for tax purposes. That's because KRA usually applies a very strict criteria to which provisions can be passed. And we saw last year banks really ramped up their provisioning. So that's something else that eats into their into their profits. Fourthly, the Credit Information Sharing Association of Kenya, which is CIS, it reveals industry code of conduct. So it had been approved on the 18th of May by the CBK this year, and it's going to focus mainly on data quality, customer protection, and customer centricity. So parties are supposed to sign up by the end of this year, and it's expected that this code will provide a framework for best practices for the non-regulated players. Just a note that banks are regulated by CBK, so their digital lending is essentially under that framework for CBK. So this code actually stipulates that where the law does not mandate credit information sharing, that the members are actually supposed to obtain clear and specific consent from customers to share their credit information. So this is mostly, you remember last year, people complained that that these lenders were sharing the information without their knowledge, even calling their relatives and such. So this is supposed to curb such occurrences. So digital lenders are supposed to be ushered back to the credit information sharing, which will allow parties to access and list borrowers in CRB under the CBK Amendment Bill, which is now under, it has now gone to Parliament for consideration. So looking at the results, we saw I&M also released the results last week. So they reported a 31.9% rise in the earnings per share to 2.44 for the period ended 30th of June. So the asset price grew 12.3% to 382 billion, mostly due to the expansion into Uganda. We saw that they acquired a bank, that's Orient Bank Uganda, and also increased private and public sector lending. Their deposits were up by 9.6%, 276.8 billion, and their loans came to 204.5 billion, that's 10.8% increase. Notably, their borrowings also went up by around 70%, mainly due to the funding they received from development finance institutions. Just, I think last month, they had acquired about $50 million loan from IFC and FMO. The net interest income went up 28.1%, mainly to 8.9 billion, mainly due to the increased investment income from government securities. And the net fees and commission came in at 2 billion, just marginally higher by 5.5%. Operating expenses before provisions went up 22.4% to 5.9 billion, and mostly it can be attributed to a 17.3% increase in staff costs. And other operating expenses went up 23.5% year-on-year to 2.2 billion. So the profit after tax came at 4.3 billion. That's a 33.2% increase. And the board of directors didn't recommend a dividend for that period. Moving on to NCBA. So the group reported a 60.8% rise in their earnings per share to 2.83. The balance sheet grew 5.6% to 542.6 billion, with the deposits up to 437 billion, that's 12%. However, the loan book actually contracted 3.5% year-on-year to 239.6 billion. Net interest income went up 19.7% to 13.4 billion, mainly due to the increased interest income from government securities. As we've seen, banks have been lending more to the government than to the private sector because it's perceived to be less risky. Non-interest income went up 6.3%, mostly due to higher FX trading and fees and commissions on loans and advances. Total operating income at 24.1 billion, raising 13.4% year-on-year, though the operating expenses fell 4.1% to 16.3 billion. So the group also reduced the loan loss provisions to 5.9 billion, a 23.3% decrease. Profit after tax at 4.7 billion, which is a 76.9% rise in profits. And the bank actually recommended an interim dividend of 75 cents with a book closure of 12th of October 2021. So that NCBA has resumed interim payments, joining Stanbic Group. However, the other banks like KCB, Equity, ABSA, and Stanchart didn't pay any interim dividends. Moving on to BK Group. So BK Group reported a 41.5% rise in the profit after tax to 22.8 francs for the period ended 30th June 2021. So this is equivalent to about 2.5 billion shillings. So the assets base also grew 20.4% to 1.4 trillion Rwandese francs. That's 153 billion in Kenya shillings. Deposits were up 14.2% with loans up at 7.5%. So customer deposits, that was 857.1 billion Rwandese francs. That's about 93 billion shillings, as well as loans at about 100 billion shillings. That's 916 billion Rwandese francs. For total interest income, it went up 28%, with interest expense reported at 18.6 billion. That's about 2 billion Kenya shillings. So net interest income at 67.2 billion Rwandese francs, 7.3 billion shillings thereabout. That was a 29.7% rise, with net non-interest income going up by 26.6% to 16.2 Rwandese francs. That's about 1 billion shillings. So the profit after tax came in at 33.8 billion Rwandese francs. That's about 3.7 billion shillings, which is a 45.3% year-on-year rise. So the bank did not recommend an interim dividend. Just to note that this is a Rwandese bank that had cross-listed on the NSE in 2018. Looking now at insurance companies, UAP released their 1H 2021 results with an improved earnings per share from a loss of 0.33 to a positive figure of 0.62 shillings. So their premiums actually went up 33.1% to 14.6 billion, with the net premiums coming in at 9 billion. That's a 17.4% increase. Mostly they attributed this growth from their long-term insurance business that grew due to strong corporate sales. Another pointer was that the investment income also grew by over 100%, by 121% year on year to 2.9 billion, mostly due to the recovery of the equities markets. Commissions earned also went up 131.5% year on year to 1.2 billion. So net claims payable also went up by almost a half to 48.4%. To 7.2 billion, mostly due to increased medical claims. We've seen that now the claims are becoming higher due to higher hospital visits. Operating costs grew marginally by 2.3% to 3 billion. The group is trying to reduce the expenses. They're actually looking into automating their operations so that it can reduce the cost of operations. So the profit before tax, it rose to 552 million from a loss of 57, the same period, 57 million last year. So the board did not recommend payment of an interim dividend. Moving on to Britam, they posted an improvement in the earnings from a loss of 0.65 shillings per share to 0.14. So the gross earned premiums and funds management fees went up by 5.7%. Sorry, 1 second. Sorry about that. So the, sorry, 1 minute. Pardon me. So the group and the earned premiums and fund management fees rose 5.7% to 14.9 billion, with the net earned revenue coming at 12 billion, which is a 2.5% rise. So the management had said that they reported growth in both the local and the regional business, with mostly the international general insurance contributing 24% of the gross earned premiums. So total income went up by almost a half, 52.2% year on year, to around 20 billion. Mostly this was due to increase in investment income, as we've seen with UAP. It's gone up by 35.5% to 4.9 billion, as well as a gain on fair assets at fair value. So in the previous period, it had come to a negative figure of negative 3.2 billion, but now in this current period, it came to 1.4 billion. Thus, it boosted the earnings. So claims as well, insurance claims went up 15.8% to 9.4 billion, with expenses going up 24.9% to 18.9 billion. So the management had attributed this mainly to a one-off item related to their ongoing transformation process of the business. Last year, we'd seen that the group had actually retrenched a couple of employees, and that had come to also reduce their expenses. Profit before tax, it came in at 674.2 million from a loss of 2.6 billion the previous period. The board of directors for the company also did not recommend interim dividend payment. So looking at the trading idea for the week, we have a buy recommendation for Kengen with a target price of 7 shillings and 11 cents. So looking at the metrics, the counter is just slightly discounted with a price to book ratio of 0.14 versus a median of 0.15 of the industry. So the company last month had announced that it had received over 2 million carbon credits, as it's focusing its energy production into going into green energy sources. That's geothermal and solar, wind, such. So the government had actually stated that it's at an advanced stage of setting up an emissions trading system. So this will allow companies and other bodies to buy these emission allowances. So we see that this will is set to boost their earnings, like what they're going to gain from the sale, as well as due to the capacity expansion initiatives that they have planned. So that's it from my end. Back to you, Damaris, Churchill.
Thank you, Melody. Thank you, Churchill and Wesley. And thank you, everyone, for your patience. Apologies for the hiccup I had this morning, but I'm back. So after the presentation, I think we can dive in straight into the Q&A. And the first one I'd like to tackle is the one from Charles Oma. Charles is talking about his portfolio being undervalued, a situation that he's been experiencing for the past 1 month. So this is, you say you're using the Jacuzzi app. It shows that you bought your KCB shares at 40s, which is inaccurate. When will this ever be corrected? Charles, thanks for including your email address. I will send an email to the client relations team with you in copy as soon as this webinar is over, and the team will be able to advise us on the way forward. But this is nothing to worry about, especially if you're certain the price at which you bought your shares. I'm sure it's a reconciliation issue that will be sorted. We move on to Ian's question, which is a follow-up for Wesley and for Melody. Ian, I remember last week I'd asked about the meaning of the numbers after the listed counters. For example, IGAD, I remember ORD was ordinary shares, but there was also KCB Limited, ORD 1.0. Maybe it's the 1.0 and the 1.25, because I know the IMS is the sector listed on the NSE. So Melody and Wesley, did you get further insights? You had promised, by the way.
Yes.
We did our homework.
Awesome. So enlighten us. This is like trivia night.
Yeah, on further analysis, the numbers actually are the par values for the company.
Expound.
I can assist Wesley on that one. So if, let's say, you see now KCB has 1 at the end, so that's the par value of each share. So maybe if it has about 2 billion shares outstanding, so it's 1 times 2, so the value of the shares is actually 2 billion. So just the par value of each share. Okay, all right. Well, that seems like it's something easy we should have known. Now we know. It's these things which are common that usually elude us. So thanks, Wesley and Melody, for doing your homework. Justin has another question. He's asking if the research team follows Centum. Are you able to give us a fair market value for the equity? We know the real estate sector is struggling, but we have seen real estate recover sharply in places like the US and the UK. Are we expecting the same to happen in Kenya by next year once we start vaccinating for COVID? Also, do you recommend buying for the mid-term hold, that is 2 to 5 years? So that's an in-depth question regarding Centum. Who'd like to tackle it?
Let me go for them. They can chime in on the high level thinking, but looking at Centum, we don't follow it actively, but we keep tabs with Centum on what's unfolding and their financials, and looking at on the fair market value. In as much as we don't have a figure, we know that their price to book indicates that their fair market value might be quite high, and also on the real estate sector struggling. Well, you know, if Centum reported, they had a significant amount that was from the unrealized gain. So looking at it from that perspective, you see that for a medium-term hold, 2 to 5 years, we really have to wait and see how the next government that's coming, how it will react on infrastructure, especially on the real estate. For this government, we know they have the Big Four agenda, which is heavy on the real estate sector. So you find this rising tide in a way lifts up all the boats in the sector. But for that medium term, after this government, we can wait and see how the next will take on the real estate and infrastructure. to make a clear view on that midterm weight for those 2 to 5 year period. Sir Churchill, might you have something to chime on?
Thanks, Wes. Mine is more or less trying to bring the nexus in terms of the real estate in the US or UK compared to the Kenyan one. And if, for example, if you look at the if you take a deep dive into the inflation breakdown, the sectors that they look at, you find that our component of housing is like 8% or even lower than that, lower than 8%. A huge chunk of our inflation is driven by, say, food inflation, for instance, whereas in the US market, a significant chunk of the inflation is outside the wages. You find that now a sector such as real estate, which has an outsized segment, which has an outside share of income in the US. So you find that it's easier to see a direct correlation. If there's a recovery in the economy, you find that the sector that will rebound in tandem to that recovery is a sector such as real estate. So there's that direct relation in markets such as the US, other markets such as UK, but you can't see it in the Kenyan market as such, that kind of recovery that you're seeing that has been pointed out, and you're seeing even in the numbers that are coming out in the US market. So, and the other points that Wes had mentioned, I mean, our real estate is also determined to a large extent even to the political risk noise that we are getting into as we head into next year. So there are some other factors that might derail even a complete recovery in the real estate sector, which will now weigh on the fundamentals for Centum. Let me stop there.
All right, thank you, gentlemen, for that response. We move to Elvis' question. He's asking if the tea sector is good for an investor.
Well, let me just chime in here before my colleagues join in. For tea sector, you're looking at names such as Kapchorwa Tea, Williamson Tea, Limuru Tea. Well, how do you express your conviction to the tea sector? 2 ways investors get into any particular stock: capital appreciation or dividend payments. So in terms of even the activity that you're seeing in those names, I know there are 6 names in the agricultural sector, but now specifically the ones that are the tea related names, of course, Sasini is also there, though it has a diversified portfolio. IGADS, I think it's more or less coffee. Kakuzi also is diversified, but it's more of macadamia. So that's why I'm sticking to those 3 listed names. So in terms of even the volumes that trade in those 3 names, Limuru Tea, Williamson Tea, or Kapchorwa Tea, I mean, those stocks are quite illiquid. So you may find that you stick out into those names in the event that you want to accumulate a number of shares. Either there's illiquidity when you want to enter or when you want to exit. So that's what you've seen play out in some of these names. But nonetheless, that curbs against price appreciation. But nonetheless, Kapchorwa Tea, Williamson Tea, those are dividend plays amongst the tea sector names. We've seen that they have been giving us generous dividends, like in the order of 10% or lows or highs of 8%. So those, at least for dividend payments, you're good getting into those names. But for price appreciation, it may take a while. You just need to enter for the long haul, not for the short term. Yeah.
Understood, Churchill. Thank you for that. Ian has a question about Crown Paints financials. He says they looked solid. What is your general view over the counter? He also talks about Scan Group. What does it look like in future for the counter? Also, they added that their half-year results will be delayed. How does this affect it in the short term? So questions about Crown Paint and Scan Group.
Okay, let me take the Crown Paints question first. Well, yes, Crown Paints had a strong, they reported strong results, but looking at the main risk that this counter is tied to its subsidiaries, which for a really long time they've been reporting not so pleasant results and have been really, they have been relying on their parent company, which is the Crown Paints Kenya, for provision of working capital. That said, one of the key drivers for Crown Paints is the construction sector growth rate. There's a high correlation, a strong positive correlation between the real estate growth rate and the top line of the company. And when the sector is vibrant and more so home builders in the real estate sector, Crown Paints consumptions usually is on a skyrocket on the back of renovations and fresh builds. So with that in mind, and the real estate sector growing and also having the Big Four agenda in mind, at least for the next 1 year, Crown Paints is a strong counter. The only issue maybe that an investor should watch out for, it's how its subsidiaries, that is the Regal Paints and the Crown Paints, the Regal Paints, Crown Paints Rwanda, Crown Paints Tanzania, how they perform, because that has been the pebble in the shoe for Crown Paints. But that said, Crown Paints is a really, it has some promising growth.
Thank you for that, so who's going to handle the question on Scan Group now that we know that Crown Paints has potential?
Let me take Scan Group too. Well, I think for the last 3 or 4 weeks, Scan Group has been on the top losers of the week, and we saw some heavy investors were heavily exiting the counter. And looking at the financials, they were not so pleasant, although looking at something like the top line, considering the COVID-19 headwinds during the period, it was quite commendable. But that said, the financials are not, they were not the driver to the performance you're seeing right now. The key driver to this performance has to be the exoneration of the senior management that was early on suspended. And that comes as a big news that actually took the spotlight from the financials in a way. And yeah, 2020 was a hit for all the market participants. So there's that grace that's extended to Scan Group in regards to the financials. But the key factor being that there was no direct adverse effect from the suspension on the company's financial performance, financial position, and its operations. I think it trapped the investor confidence in a good way. And that, with that said, yes, they have issued a delay, an announcement on a delay of their half-year results, but I don't think that will have a big impact in the near term, because I think investors are still digesting the news on the news on the exoneration of the senior managements, and also pricing in the FY20 results. And in the short term, I think the key driver will be, actually based on what we've seen, it's investors accumulating on the shares they earlier on exited on the counter. Might you have something to add on that?
Okay, that is very positive feedback. Thanks, Wesley. Eric has a question regarding the infrastructure bond. So do market regulations allow a green shoe option without an issuer having made a disclosure in the prospectus? So Churchill, you touched on them accepting bids worth more than they advertised. So is this allowed? Eric would like to know.
Wow, quite an interesting question, putting me on the spot. Anyway, is it allowed? Interesting question. How do we put it? It's one of those things that are not explicitly mentioned, but implicitly mentioned. Looking at even the infrastructure bonds that were issued this year, that's in January, the IFB1 2021-16, and then in April, IFB1 2021-18. What the amount that was sought was 60 billion. What ended up being accepted was 80 billion. So there was a difference of 20 billion. So you could implicitly imply that there was a green shoe option of 20 billion that was exercised. And then the question the heart of it. At what point is it crafted in law that it has to be announced? I don't know whether it's this Pavlovian theory. I'm sure Damaris, that red book behind you, it's a book on Pavlovian theory. You know it's that one to your right. Anyway, the experiment about the dog, where the bell is rung, then the dog is given food, and then with time, the dog associates the bell with food or lunch, something like that. So that's the theory behind it. So I don't know whether at some point they used to do that, and then it became like, okay, there's just some green shoe option. Because I haven't seen, ever since I've been in the industry, well, not the longest time, but not the shortest time nonetheless, I haven't seen explicitly in the prospectus that they've been mentioning that this amount will be the green shoe. But what subsequently happens, what is left unsaid speaks louder than what is not even said, that what is not explicitly said. And that's what actually plays out with the infrastructure bond issues. Yes, 75 billion is being sought, but what we are seeing, the high liquidity in the market, there's so much interest in this particular paper, which has sniffed out activity in the secondary market. So that's telling us that activity is being driven to this primary bond issue. So you could see an outsized subscription, but that will give CBK, or rather the Treasury, some latitude, at least to accept more than what is indicated. So that's where our thinking that perhaps just to round it off, we could see 100 billion being accepted, a round figure, nice round figure. Of course, not 87 billion, but something round figure of 100 billion. So that's where the 25 billion was coming about. But there's no some regulation that explicitly mandates them to put it on the prospectus. Yeah.
Understood. Thanks, Churchill. Nelson asked a question. He would like to get some insights on the BOC Kenya counter. So do you guys cover BOC, and do you have insights to share with Nelson? I could hear a pin drop.
Okay, unfortunately, we don't cover BOC, so we might have to go back and find out some more information for you. But we know that due to the COVID-19 pandemic and the hospitalizations, there's been that increase of demand in gases. So that could drive their revenue because they're saying even the demand is higher than the supply. So you might find that that may drive their earnings for some duration in the short term. Though looking also at the industrial use of gases, they saw that the manufacturing sector was quite depressed last year due to the pandemic. So hopefully if demand comes up again this year, you might see that also supplementing into their revenue. That's what I think. Anyone else has something to add on?
Good stuff, Melody.
Yeah, obviously there's that issue about the merger acquisition of Kabasid BOC that is still playing out, still in the courts, so to be determined. But nonetheless, you captured your sentiments around that BOC quite well.
All right, thank you, Nelson. I hope that is satisfactory. If you have follow-up questions, please be like, was it Ian, the person who was asking about the counter naming? Just join us next week and ask them another question, since they said they would read up on it. Sawa.
I have a small addition for the one for tea. So they had introduced a minimum price reserve for tea, I think last month in July. So that should be able to keep the tea price levels higher than the way it had been, because it's been falling to almost $1.90. But now they've put a minimum standard that the price should not fall below $2.43. So it's expected that now that will help to maintain the prices and to keep boosted the volumes and the prices as well. So that's for the tea sector.
All right, awesome. Okay, NBV is a regular attendee of these meetings. Speculation is still high, and I know Wesley is a go-to guy when it comes to NBV. So both Nalco and Jandy have questions. Nalco says he missed the NBV. I don't know if you spoke about it in your presentation. He asks, what are your targets, buy or sell? He personally sees it reaching 10 bob. I know for the longest we've been saying it's a speculative buy, but maybe you could address that. You can combine it with addressing Jandy's question. He's asking whether it's advisable to invest in NBV with the upcoming merger. So two very interesting questions. Wesley, as always.
Wow. Okay, I'll give my 2 cents, then I'll pass it on to my high esteemed colleagues to give their high level thinking around it. Well, BV, to keep it short, they reported a strong financial position in their recently released results. The eye will be, and this is an out of consensus view, the business is expected to pay the acquisitions in share allocation. That is a really, it comes as a news that we will expect to see some high investor activity in terms of speculation. And yes, when these acquisitions are boxed in, we expect to see some rise in price, but till then we can't even value this company because we have to see how much all these companies are worth, and all this news is still not out there yet. So NBV is still highly speculative, but we are of the view that the price action on the counter will be range bound, and it's projected to rally above its 52-week high levels when the second transaction phase will be completed. Thus, agreeing with by Nelco and Ndega on the prices, seeing it to high levels of almost 10 shillings and even beyond. But that will be on the back of the completion of the second phase of the transactions.
Jolly good. Churchill or Melody to add on? Melody looks ready.
The only thing is that the transaction, it's about 18 billion, and they're going to raise just about 3 billion from issuing additional shares. So there's a question of where they're going to get the other funding from. That's just the factor that they can see can affect the price.
All right, thank you so much. We have Robert who's following along on our Facebook live stream. Robert's question really centers around Jacuzzi. He says, big concern is that on Jacuzzi investment app, the bond section has been coming soon since time immemorial. You're quite right. When do you plan to have this active so that we can buy bonds in the secondary market on the Jacuzzi app? Robert, I think the biggest issue has been integrating the system that's used to trade. I don't even think there is okay, let me not comment on that. Let me just say there's been a lot of logistics around integrating the secondary market for bonds within the app itself because of the way which orders are pushed to the market. So for now, if you would like to trade in bonds, we just have to go the old-fashioned route of contacting us via email and sending us instructions. You can always reach out via the chat function inside the app and say, I'm interested in the infrastructure bond, please guide me. And then the team will be able to contact you. And of course, use your CDS account to fund and then buy the bond for you. James Wahome also on the Facebook chat notes that this will be a game changer. Hope it comes through soon. Trading the secondary bonds is almost impossible as things are at present. I concur, James, that they're quite hard. But let's wait and see where our technology is taking us. We've gotten so far, so hopefully we'll get further along. Nalco, thank you so much for your kind comments. Nalco had mentioned that he appreciates the consistency of our briefings. We also appreciate the consistency of you guys attending and giving us an hour of your Monday morning. I think I've seen one more question, and perhaps we'll just answer George's question and then we'll call it a wrap. Churchill, you vanished. The cup of tea can wait because I believe this is for you. George asks, do we use a multi-price method during primary auctions? You see, Churchill, that's a question for you. And then after we answer Makori, who's a regular, we'll be able to call it a wrap.
Oh, I'll love to confirm this one. I know with how they the rejection of bids. I'll have to confirm this one, to be honest. I hadn't even thought about it. So this is another question we'll spill over to next week.
Okay, wow. Kudos, Makori, a question that stumped Mr. Churchill himself. I have lived.
Makori is a fixed income guru, so trust him.
Makori, please be attending and be sure to raise this question again for our team next week, Monday. So Violet, thank you. And thank you to everyone else who stuck with us through the Q&A. We will see you next week, Monday. Have a great week ahead and stay safe. Bye.